Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
All right, class, welcome. So let's talk about something you're all going to face the second you start investing. You see, you've got this silent partner, a partner you never asked for, and that partner is the tax man. For every single dollar your investments earn, they're right there looking for their piece of the pie. So, in this explainer, we're going to break down the key strategies to make sure you legally, and that's the key word legally, keep as much of your hard earned money as possible. We want to make sure you don't overpay that silent partner by a single penny. And make no mistake, this isn't some minor detail. Let me be perfectly clear. Successful investing isn't just about picking the next hot stock. It's about knowing the rules of the game so you can legally protect your profits. Mastering this stuff, that's what separates a pretty good return from a return that can actually change your life. Okay, so here's our game plan for today. First, we'll figure out who this silent partner really is. Then, we'll get into the profit calculation rule, how they figure out what you owe. Next, and this is a big one, we'll see how to make your interest deductible. We'll also navigate the different types of income because they're not all treated the same. And finally, we'll ask the big question. Is your debt smart? Let's dive in. All right, let's jump right into section 1, your silent partner. Before we can outsmart our partner, we have to understand them. So we're going to define what property income actually is, and just as importantly, what it isn't. Okay, so what is property income? The magic word here, the one I want you to burn into your brain, is passive. This is the money your money makes for you, literally while you're sleeping. It's the dividends that pop into your account from stocks you own, the interest from a bond, or the rent check from a property. The key is you're not actively working for it. You're not trading your time for dollars. You're getting paid simply for owning an asset. Now, this next point is absolutely crucial, so listen up. You have to get this distinction right. Property income is not the same as a capital gain. Think of it like this. If you own an apple tree, the apples you get every year, that's your property income. It's the ongoing cash flow. But if you one day sell the entire tree for more than you paid for it, that one-time profit, that's the capital gain. And trust me, the tax authorities treat them completely differently. They're taxed in different ways and at totally different times. So what this all boils down to is this. It's not about what the income is, it's about how you earn it. This is the core concept. Look at a bank, right? When a bank earns interest, that's their day job. It's active, that's business income. But when you earn interest from that same bank on your savings account, for you it's passive, it's property income. The only thing that changed was the level of active involvement. Same type of income, totally different tax treatment. Okay, let's move on to section 2, the profit calculation rule. Now that we know what property income is, let's talk about the big question. How is it actually taxed? And I've got some good news for you here. You are not taxed on every dollar that comes into your account. You're only taxed on your profit. And the formula for this? It's actually super simple. Just 3 basic steps. First, you take your gross revenue. That's all the cash that came in the door. Second, you subtract any eligible expenses, basically the cost of earning that revenue. And third, what's left over is your net profit. That final number, that's the only part that gets taxed. Simple as that. So the obvious question is, what makes an expense eligible? Well, there are 5 tests here, but honestly, the most important one, the one that trips people up all the time, is that it absolutely cannot be a personal expense. You can't write off your trip to Cancun, right? But you can write off the interest on a loan you took out to buy an income-producing stock. And that simple difference, that's the key that unlocks a really powerful tax strategy, which we're going to get into right now. All right, section 3, this is where things get really fun. We're talking about making your interest deductible, and we'll use a case study about Mr. L to show you how. Look, using borrowed money to invest can be an absolutely amazing strategy, but, and this is a big but, only if you do it the right way. This is one of the single most powerful tax-saving tools you have in your arsenal. So to make this crystal clear, let's walk through a little scenario. I want you to meet Mr. L. He's got $13,000 in cash sitting in his bank account. Now, he has 2 things he wants to do. He needs a $10,000 car, that's a personal purchase, and he also sees a great opportunity and wants to make a $10,000 investment. You can do the math, right? He needs $20,000, but he only has $13,000. He's short by $7,000, so he has to go get a loan. Okay, so Mr. L is at a crossroads, and he has 2 very different paths he can take with that $7,000 loan. Let's look at the wrong way first. He gets the loan, dumps it into his main bank account, mixing it all up with his personal cash.
Then he buys the car and the investment from that one big, messy account. The result? There's no clear paper trail. You can't prove what money was used for what, so that interest is not deductible. Game over. But now look at the smart way. It's so simple. He uses his own cash to buy the personal car. Then he takes out that loan and deposits it into a brand new, completely separate bank account. From that account, and only that account, he buys the investment. The result? A perfect, clean, traceable paper trail. And because of that, every single penny of interest he pays on that loan is now deductible.
So what's the lesson here? It all comes down to one thing, and one thing only, the paper trail. You have to be able to prove with zero doubt that the money you borrowed went directly into an income-earning investment. Setting up that separate bank account, it makes the whole thing clean, simple, and completely undeniable to the taxman. It's your proof.
All right, great. So we've got the general principles down. Now let's zoom in a little bit for Section 4, navigating different income types, because it turns out that not all property income is created equal. We're going to quickly hit the big three you'll most likely encounter: interest, dividends, and rentals.
First up, interest income. Now, the rules are a bit different for corporations versus individuals, but for you, the key thing to know is something called the anniversary day rule. Basically, it means that even if you haven't actually received the cash in your hand yet, you have to report the interest your investment has earned at least once every 12 months. Why? Well, it's pretty simple. It stops people from deferring their tax bill indefinitely.
Next up, dividends, specifically dividends from Canadian corporations, because these get special treatment. There's this concept called tax integration, which sounds complicated, but the idea is simple. It's designed to prevent the same dollar of profit from getting taxed heavily twice, first when the corporation earns it, and then again when you get it as a dividend. And the way we do this is through a neat little system called the gross up and credit.
So, how does this whole thing work? Well, it's a two-step process. First, the dividend you actually receive gets grossed up on your tax return. This is basically an estimate of the company's pre-tax profit. You'll see there are two types: eligible, usually from big public companies, and non-eligible, often from smaller private ones. Then comes the good part. You get a dividend tax credit, or DTC, which directly reduces the personal tax you owe. It's basically the government's way of saying, hey, we know the company already paid some tax on this, so we'll give you a credit for it. This makes Canadian dividends a really, really tax-efficient way to earn money. And finally, let's talk about rental income. The big deduction you can claim here is for the building's depreciation, which we call capital cost allowance, or CCA. But there are two really important rules you have to know. Rule number one, you can't use CCA to create or increase a rental loss. You can bring your rental profit down to zero, but you can't use it to create a loss to go shelter, say, your employment income. And rule number two, bigger rental properties, anything over 50 grand, have to be in their own separate class. This stops people from playing games with the numbers when they sell one property out of many.
Okay, I know that was a lot of the technical nitty-gritty, so for our final section, let's just boil everything we've learned down into two simple, powerful, golden rules for your finances. Ready? Let's ask the question, is your debt smart?
Golden rule number one, this is so important. Always, always use your own cash for personal items. I'm talking about the car, the cottage, that fancy new boat. Why? It's simple. The interest you pay on a loan for those things gives you zero tax deduction. It's just a cost. Save your borrowing power for things that'll make you money and give you a tax write-off.
And golden rule number two flows right from the first one. Always pay down your personal, non-deductible debt first. We're talking credit card debt, car loans. Get rid of that stuff before anything else. Think about it. Every dollar of interest you don't have to pay on your credit card is like earning a guaranteed, completely tax-free return on your money. There is no investment on earth that can be a guaranteed tax-free return.
So I'm going to leave you with this one final question to think about. I want you to go home and take a hard look at your own finances. Is your debt just a cost, something that just drains your wallet every single month? Or have you started to structure it like a smart tool, one that is actively working for you, saving you money on your taxes? The answer to that question, class, could be one of the most important factors in building your financial future.